There is a window in your financial life so narrow, so precisely defined, and so mathematically valuable that the IRS essentially designed the entire modern retirement code around the assumption you would miss it. The window has a name, the income valley. And in 2026, 3 separate legal mechanisms are either closing, expiring, or becoming permanent in ways that will never fully overlap again. This video is going to show you exactly what those 3 mechanisms are, how they interact, and why the people who understand this are quietly doing more for their retirement in the next 12 months than they did in the previous decade combined. Most people believe they will pay lower taxes in retirement. The financial advice industry has built an entire ecosystem on that assumption. Max your 401k, defer the taxes, retire in a lower bracket, and everything works out. Sounds elegant. Unfortunately, the math breaks down for a very specific reason. And by the time most people notice the math is broken, it is too late to fix it. The magic number Americans think they need to retire comfortably in 2026 is $1.46 million. That is $200,000 more than the figure from 2025. And the median retirement savings for those aged 55 to 64 is just $185,000. So the gap between what people have and what they think they need just got wider. The average person in their 50s is not on track. But here's the twist. The people with more than $500,000 saved in traditional pre-tax accounts may actually be in a worse position than they think. Not because they saved too much, because of where they saved it. The retirement move I am talking about today is called a Roth conversion. You have probably heard of it. But the reason 2026 is specifically important, the reason I'm making this video right now and not 2 years from now, is that 3 entirely separate windows are either closing or approaching an expiration date simultaneously. And if you are between the ages of 55 and 68, at least one of these windows applies directly to you, probably 2. Here is the central idea, and I will come back to it throughout this video. The income valley is like low tide. It only happens when certain conditions align. Right now, the water is still out. You can still see the ocean floor. At 73, the tide comes back in permanently, and anything you did not move to safer ground gets submerged. Stay with me, because in a few minutes, I am going to show you how an accountant from Ohio named Donna did everything right by conventional standards for 30 years and still ended up in a higher tax bracket in retirement than she was in during her working years. And her story is not an edge case. It is a math problem with a very common answer. But first, I need to explain why the assumption about lower taxes in retirement is not wrong in theory, it is just wrong in practice for a very specific category of person. The most financially successful person in the room. Let us start with the escalation cycle that catches the most people off guard. If you are 60, 61, 62, or 63 years old right now, in 2026, you are sitting inside what is mathematically the single most powerful contribution window the American tax code has ever created for someone approaching retirement. And it expires the day you turn 64. Under a change made in Secure 2, a higher catch-up contribution limit applies for employees who turn 60, 61, 62, and 63 in a calendar year starting in 2025, who participate in most 401k, 403b, governmental 457 plans, and the federal government's thrift savings plan. For 2026, this higher catch-up contribution limit is $11,250. Let that sink in for a second. The 2026 standard annual deferral limit is $24,500. The catch-up contribution for ages 50 to 59 and 64 or older is $8,000, is less than BR, is greater than the special. Super catch-up for ages 60 to 63 remains at $11,250. So here is the math. If you are 63 years old in 2026 and you participate in a 401k, you can contribute $35,750 to that account this year. That is $24,500 in regular contributions, plus $11,250 in the super catch-up. When you turn 64, your maximum drops to $32,500 permanently. You lose $3,250 of annual tax advantage contribution capacity forever, starting the year you hit 64. That sounds like a footnote. It is not. Run it out over 5 years. If you invest that extra $3,250 per year at 7% annual return, a perfectly reasonable expectation for a diversified index portfolio, you are looking at roughly $20,000 in additional compounding just in the 5 years before retirement, tax advantaged. And that is conservative. Beginning in 2026, the Secure 2 Act is mandating a change in how higher earners age 50 and over make catch-up contributions to their employer-sponsored plans. Beginning on January 1st, 2026, workers who are 50 or older and earn more than $150,000 in FICA wages in the prior year must make any catch-up contributions on a Roth basis. This second piece is where it gets interesting. If you earned more than $150,000 in 2025, your catch-up contributions in 2026, whether you are in the standard age 50 plus bucket or the super catch-up 60 to 63 bucket, automatically go into Roth. You do not get a choice. And here's the thing. Most people hear Roth and immediately assume that means bad because they are used to the idea of deferring taxes. But in 2026, the Roth bucket is not the booby prize. It is the prize. I will explain exactly why in a moment. But I need to plant a flag here. There is a good chance your employer does not even know this rule exists yet. The Secure 2 Act initially set the Roth requirement for catch-up contributions by high-income earners back in 2024. However, its implementation has been delayed until 2026 due to logistical challenges faced by employers and retirement plan administrators who were unprepared to handle the administrative changes required. If your HR department missed the memo, and many did, your plan may not have even updated its documents yet. The deadline for plan amendments is December 31st, 2026. The operational compliance requirement started January 1st. That is a gap big enough to drive a truck through. Check your plan. Call HR. Confirm. Because if you earned over $150,000 last year and your plan has not updated its Roth catch-up structure, you may be sitting on a compliance issue that affects your ability to make catch-up contributions at all. In a few minutes, I am going to show you the specific math on why someone with $850,000 in a traditional IRA who does not convert any of it may actually pay more in taxes over the course of their retirement than someone with $300,000 invested in taxable accounts. The numbers are counterintuitive. And that counterintuitive result is the engine that powers the move I am describing today. But first, let me tell you about the low tide, because everything in this video is downstream of one basic idea, and I want to make sure we are on the same page. When you retire before Social Security kicks in and before your RMDs begin, something unusual happens to your taxable income. It goes to almost nothing. For most people, this is the first time since their mid-20s that their income is genuinely low, not because they are broke, but because they are drawing on assets that were already taxed or on dividends and capital gains that are taxed at preferential rates, or they are living off cash savings they accumulated before retirement. The ocean floor is exposed. You can see the bottom. This is the income valley. For those early retirement years, taxable income is essentially zero. This is the Roth conversion window. For most retirees, it is the single most valuable tax planning opportunity they will ever have. The problem is that the tide does not stay out forever. Once required minimum distributions begin at age 73, you will be forced to take taxable distributions whether you need the income or not. And if you have done your job, if you actually saved well, those RMDs will be sizable. According to IRS Uniform Lifetime Tables, a 73-year-old with a $1 million traditional IRA must withdraw roughly $37,700 in their first RMD year. Add Social Security. And here is the part that blindsides people. And you quickly discover that up to 85% of your Social Security benefit becomes taxable income once your combined income crosses $44,000 for a married couple. So you have got mandatory IRA withdrawals piling on top of Social Security benefits. that are now partially taxable, and suddenly your lower bracket in retirement assumption has evaporated. If you are already claiming Social Security, a Roth conversion that pushes your combined income above $44,000 causes more Social Security income to become taxable. The effective marginal rate on a Roth conversion in this range can be significantly higher than the stated bracket. You think the problem is not having enough money saved. The actual problem, for a surprising number of people who did everything right, is having too much of it sitting in the wrong kind of account. This is where Donna comes in. Donna taught high school math in Columbus for 31 years. She maxed her state teacher pension contributions the entire time. She also contributed to a 403B, the school district's version of a 401k, consistently for 25 years. She retired at 62 with about $1.1 million across her 403B and her IRAs. Her financial advisor gave her the standard, "Relax, you've done well" speech. He told her that once she stopped working, her income would drop and her tax situation would simplify. At 73, her first RMD came due. The IRS calculation required her to withdraw approximately $42,000 from her IRA. Her Social Security benefit she had claimed at 65, which we will discuss in a moment, was $28,000 per year. Her pension paid $19,000. Total income in year one of RMDs, $89,000. 73% of her Social Security became taxable. Her effective federal tax rate was higher in the year she turned 73 than in any year of her working career. Her financial advisor had never modeled this. He had run projections on investment growth, on withdrawal rates, on longevity. He had not run projections on the compound effect of RMDs stacking on top of Social Security in the same tax year. By the time Donna saw the numbers, the window for low-cost Roth conversions had closed. The good news is that you are reading this in 2026. You are not Donna yet. By the way, hit subscribe if you like this content. Otherwise, the YouTube algorithm may never show you my videos again. Here is how the income valley is supposed to work when you actually use it. Take someone who retires at 62 with a traditional IRA worth $1.1 million. Social Security she has not claimed yet, and modest investment income of about $18,000 per year from dividends and interest. For the next 8 years until she turns 70 and claims Social Security, her taxable income will be unusually low. Her standard deduction plus modest investment income means she is in the 12% bracket with significant room to spare. That 8-year window is one of the best Roth conversion opportunities she will ever have. The math behind this is worth spelling out. A $100,000 conversion growing at 7% for 25 years becomes $542,743 of completely tax-free money. That is money that will never be subject to RMDs. Money that, when it grows, does not create a tax bill. Money that your heirs can inherit and continue growing, largely tax-free. A client who retires at 62 and does not start converting until 68 has lost 6 years of 10% and 12% bracket space. At $133,000 per year in the 12% bracket, that is $798,000 of conversion capacity gone. $798,000. That is not a rounding error. That is the difference between a fully converted RMD-free Roth balance and a traditional IRA that generates mandatory taxable income for the rest of your life, whether you need it or not. So the income valley is the low tide. And the question is, how much of the ocean floor can you uncover before the tide comes back in at 73? Here is the complication that almost no one in the financial media is talking about seriously, because it is nuanced and the internet does not reward nuance. IRMAA thresholds. IRMAA is based on MAGI from 2 years prior. A conversion in 2026 affects Medicare premiums in 2028. The first IRMAA cliff for married filers is at $212,000 MAGI. If your 2026 MAGI from a conversion crosses this threshold, your 2028 Part B premiums increase by approximately $74 per month, $888 per year per person. So there is a ceiling. If you are already on Medicare or about to go on Medicare in 2028, you cannot just convert everything in a single year. You have to stay below the IRMAA cliff. For most people, that means the optimal conversion amount is somewhere between $60,000 and $120,000 per year, depending on their specific income picture. You're filling the bracket up to the edge of the cliff without going over. The reason this matters right now, in 2026 specifically, is that there's a third layer to this story, one that most people have not yet integrated into their Roth conversion planning. Here is the gap angle. Knowing these numbers is one thing. Building a system around them with the specific windows that are open right now is something else entirely. I spent about 2 years building exactly that system. I pulled 50 years of retirement data, stress tested every major claim the financial industry makes about withdrawal rates, and wrote it all down in a book called The Exit Code. It is 8 chapters of pure research. No filler, no motivational talk, just the math. One of the things I cover in detail is something I call the 4% trap. Why the conventional 4% withdrawal rule fails in early retirement specifically, and the dynamic withdrawal method that replaces it. This connects directly to everything we have been discussing, because the way you structure your withdrawals during the income valley determines whether you actually execute the Roth conversion strategy or whether you drain your taxable accounts too fast and run out of room. I also cover what I call the unretirement paradox. 81% of early retirees in one specific community went back to work within 3 years. And it had nothing to do with running out of money. Understanding why that happened is the difference between a retirement plan and an exit strategy. The exit code is available through the link in the description. It costs less than one dinner out, and it is built on a mathematical framework that turns "I should probably think about this someday" into a specific date on a calendar. If you are watching this video, you are the exact person I built it for. Now, back to the third window, because this one is the one that has a hard expiration date, and it is the one that is most invisible. Effective for 2025 through 2028, individuals who are age 65 and older may claim an additional deduction of $6,000. This new deduction is in addition to the current additional standard deduction for seniors under existing law. The One Big Beautiful Bill Act, signed by President Trump on July 4th, 2025, created this deduction as a temporary measure. The deduction is only temporary. It applies for the 2025 through 2028 tax years, but then it expires. The OBBBA creates a new $6,000 senior tax deduction for each taxpayer 65 and older, up to $12,000 for married couples, starting with the 2025 tax year and running through 2028. It phases out for single filers with modified adjusted gross income above $75,000 and joint filers above $150,000. Think about what this means in the context of Roth conversions. If you are 65 and your baseline income is very low because you have retired and you have not started Social Security yet, this deduction is essentially a $12,000 offset against your conversion income. You can convert more dollars while staying in the same effective tax bracket. The window for using this tool is 2025 through 2028. You have already missed 2025. That leaves 2026, 2027, and 2028. 3 years, and then it is gone, unless Congress extends it. The deduction offers a consistent benefit through 2028, helping with budgeting and planning. But the financial planning industry has been slow to incorporate this into Roth conversion modeling. I have talked to advisors who are still running their clients' conversion models without the OBBBA senior deduction. That is leaving real money on the table. Here is a real-world illustration of how these three windows layer together. Meet Mark. He is 61 years old, earning $175,000 a year as a civil engineer. He has $850,000 in a traditional IRA, no pension. He plans to retire at 63. He will claim Social Security at 70. His wife is 62 and also has a traditional IRA with $400,000. Mark is turning 62 later this year. That means he is inside the super catch-up window, 60, 61, 62, or 63. He can put $35,750 into his 401k this year. Because he earns over $150,000, his catch-up portion is automatically Roth. So the $11,250 in super catch-up goes into a Roth. 401k automatically. The remaining $24,500 goes pre-tax. He gets both the deduction and the Roth bucket in the same year. That is a combination that exists in this exact form only until he turns 64. Now, Mark retires at 63. His income drops to roughly $18,000 per year from a small rental property. His wife is not yet claiming Social Security. Their taxable income is $18,000. The 2026 standard deduction for married filing jointly is $32,200. They owe zero in federal income taxes on their baseline income. They have a full bracket of headroom. They convert $80,000 from their IRAs that year. Their total taxable income becomes $98,000. After the standard deduction, their taxable income is $65,800. The 12% bracket for a married couple in 2026 covers income between $23,850 and $96,950. They are comfortably inside the 12% bracket. They pay roughly $8,000 in federal taxes on the conversion. At 65, Mark's wife qualifies for the OBBBA Senior Deduction, $6,000. They convert another $80,000, but now they can offset $12,000 of that conversion with a Senior Deduction $6,000 each. Effective tax on the conversion drops further. The tide is still out. They do this for 7 years. By the time Mark turns 70 and claims Social Security, they have moved roughly $560,000 from traditional IRAs into Roth IRAs, paying effective rates between 10 and 15%. Their remaining traditional IRA balance is now roughly $690,000, down from $1.25 million 7 years earlier. When RMDs start at 73, their mandatory withdrawal is a fraction of what it would have been. Their Social Security is less likely to be taxed at the 85% inclusion rate. Their IRMAA exposure is minimal, and every dollar sitting in their Roth accounts is growing without ever generating a tax bill again. Compare that to the version of Mark who never heard of the income valley. He retires at 63, draws on his rental income, keeps his IRA untouched because I don't need it yet. At 73, his RMD from a fully compounded traditional IRA worth $1.4 million is roughly $53,000. Add Social Security, $44,000 per year. Total income, $97,000, which triggers 85% Social Security, taxation, and potential IRMAA exposure. His effective tax rate in the year he turns 73 is higher than in any year of his career. The first Mark paid somewhere around $65,000 in taxes during his income valley years. On $560,000 in conversions, roughly an 11% effective rate. The second Mark will pay north of 22% on mandatory distributions for the rest of his life, on a growing IRA balance he cannot stop withdrawing from. The gap between those two scenarios, over 20 years of retirement, exceeds $200,000 in taxes paid. That is not a rounding error. That is a car, a few years of health care, a college education for a grandchild. Your financial advisor will not hand you this framework. They charge 1% of your assets per year to explain half of it, and the half they skip is usually the part that costs you the most. Pause for a second here, because I want to address a thing that always comes up. Someone watching this is thinking, yes, but what about the one big beautiful bill permanently extending the TCJA rates? Aren't rates locked in now? So why the urgency? Here is the thing. The One Big Beautiful Bill Act, signed July 4th, 2025, permanently extended the TCJA tax rate structure. The 10, 12, 22, 24, 32, 35, and 37% brackets are no longer scheduled to sunset. That is true. The convert now before rates go up, panic from 2024 is officially dead. But rates are stable is not the same as converting doesn't matter. The case for Roth conversions in 2026 does not rest on rate anxiety. Roth conversions remain one of the highest value strategies available, even with TCJA rates now permanent. The case has shifted from beat the sunset to beat your future RMDs, IRMAA cliffs, and Social Security taxation. That case is just as strong, and the math often favors larger and earlier conversions than most people default to. In other words, the window is not about escaping a tax increase. The window is about arbitraging the gap between your income valley rate and your RMD year rate. Permanently low tax brackets actually make this more compelling, not less, because now you can plan with certainty. You know what you are paying today. What you do not know is what your blended effective rate will be at 75 when RMDs, Social Security, pension, and rental income are all hitting your tax return simultaneously. For retirement planning, this uncertainty is itself a reason to convert at known current rates, rather than wait for certainty that may never come. But there's one more layer to this story, and it is the layer that keeps me up at night more than any of the mechanics I have described so far. The Social Security wildcard. The most recent Social Security trustees report from June 2025 projects trust fund depletion in 2033, when Social Security would pay roughly 77% of benefits after a 23% automatic cut. The Congressional Budget Office updated its projection in February 2026 and moved the date to 2032, with the automatic cut rising to 28%. Let me put that in human terms. As of April 2026, the average Social Security monthly check for retired workers is about $2,081. A 23 to 28% cut to that amount means the average monthly benefit drops to somewhere between $1,500 and $1,600. For someone who planned their entire retirement around a $2,000 monthly Social Security check, that is a $5,000 to $6,000 annual shortfall every year, indefinitely. Two pieces of recent legislation pull the timeline forward. The 2025 Social Security Fairness Act extended benefits to about 3 million former public sector workers, adding almost $200 billion in obligations over a decade. The SSA's chief actuary also scored the 2025 reconciliation bill as accelerating trust fund depletion by roughly a year to 2032, aligning with the CBO projection. Congress's plan for fixing Social Security will definitely get to that. Meanwhile, the math keeps getting worse. Here's what this has to do with Roth conversions specifically. If your Social Security benefit takes a 23% hit in 2032 or 2033, and your retirement income plan was built around full benefits, you need a buffer. The most reliable buffer is tax-free income from a Roth account. Roth distributions do not count as income for Social Security taxation thresholds. They do not push you into higher RMD territory. They do not trigger IRMAA. They are essentially invisible to every means-tested benefit calculation the federal government runs. In other words, a Roth account is not just an investment account. It is political risk insurance. If benefits get cut, if new taxes appear, if the rules change, and historically they always change, the money in your Roth is already behind the fence. The IRS already got their cut. They do not get a second bite. The OBBBA is projected to add around $3 trillion to the federal deficit between 2025 and 2034, increasing pressure on government programs. Federal estimates indicate that Social Security's trust fund may experience accelerated depletion, and retirees could potentially face benefit cuts by 2033. The major tax provisions modeled are estimated to reduce federal revenues by $5.0 trillion between 2025 and 2034. You do not need to be a budget hawk to see where this is headed. The national debt needs servicing. Social Security needs recapitalization. Healthcare costs keep rising. The only tools the government has are spending cuts, benefit reductions, and tax increases. We may not see tax rate increases for a decade. We may see them in 3 years. The point is that you do not know. Roth removes that variable from your retirement plan entirely. This brings us back to Donna from Ohio. When I think about Donna's situation, the thing that strikes me is not the math error. It is the timing error. She had the income valley. Between 62 and 68, she had 6 years where her taxable income was low enough to convert aggressively. She did not convert because her advisor told her there was no urgency. The conventional wisdom said, rates might go down, wait and see. The conventional wisdom was wrong, not about rates, about the compound effect of doing nothing. Every year Donna did not convert during her income valley. The traditional IRA grew. Higher balance means higher RMDs at 73. Higher RMDs means more Social Security becomes taxable. More taxable Social Security means more income above IRMAA thresholds. More IRMAA exposure means higher Medicare premiums. The whole thing compounds against you, not because of market returns, because of the architecture of the tax code. The income valley is low tide. Use it. Here's a thing I want to say directly, because it is not in the glossy brochures. Most people know they should do something about retirement. They read about Roth conversions, nod along, and then do not do it. Not because they are lazy. Because the financial advice industry has not given them a system. It has given them principles. Principles without structure is how good intentions become regret at 73. 10 years of running my own business, surrounded by accountants and tax attorneys who think in systems rather than recommendations. That is what changed my understanding of this. The insight is not complicated. Taxes are the largest controllable variable in retirement income. Not returns, not withdrawal rates. Taxes are only controllable during the window when your income is low enough to act strategically. Lazy investing built more fortune than crypto memes. But lazy investing that ignores the tax architecture is just deferring the reckoning. So let me give you the 3 specific moves for 2026. First, if you are 60, 61, 62, or 63 years old and still working, confirm with your employer that your plan offers the super catch-up contribution and that it is updated for 2026 compliance. Your total contribution ceiling this year is $35,750. If you earned over $150,000 in 2025, your catch-up portion automatically becomes Roth. If you earn below that threshold, you can choose. For 2026, that amount remains the same, and to qualify, participants must be 60, 61, 62, or 63 by the end of the calendar year. Once participants turn 64, they revert to the standard age 50 plus catch-up contribution limit. This window is not theoretical. It expires when you do. Second, calculate your income valley. Take your expected retirement date. Find the year you turn 73 and subtract. That gap, whether it is 3 years or 11 years, is your low tide window. For each of those years, model your taxable income without any IRA withdrawals. Whatever headroom you have between that income and the top of the 22% bracket, currently somewhere around $109,000 for a married couple, is your annual Roth conversion capacity. Do not let that capacity sit unused. Every empty year is a year you paid the wrong tax rate on money you did not have to touch yet. Third, if you are 65 or will turn 65 before the end of a tax year between now and 2028, coordinate the OBBBA Senior Deduction with your Roth conversion plan. The deduction does not eliminate Social Security taxes, but for nearly 90% of retirees, it reduces taxable income enough that many may not owe any federal tax on their benefits. Combined with a strategic Roth conversion that stays below IRMAA thresholds, this creates a 3-year window, 2026 through 2028, to move more money at lower effective rates than will exist after the deduction expires. The deduction ends after 2028 unless extended. Do not plan as if it will be extended. Plan as if it ends on December 31st, 2028, because that is what the law says right now. You think this is complex? Here's the thing, the complexity is already there. It exists in the tax code, whether you engage with it or not. The IRS does not simplify its rules because you did not read them. The only difference between engaging with this complexity and ignoring it is whether the complexity works for you or against you. Mark's 7-year conversion plan, roughly $65,000 paid in taxes on $560,000 converted. 0 RMD obligation on those funds for the rest of his life. The alternate universe, Mark. No conversions. Watching a growing traditional IRA generate mandatory taxable income from age 73 until he dies at rates consistently above what he paid in the income valley. The math is not subtle. The action is just uncomfortable. Because paying taxes now, even strategically lower taxes, requires writing a check today for a benefit you you will not fully appreciate for 15 years. That is a hard psychological trade. Most people do not make it. And the financial advice industry, which gets paid on assets under management, not on tax efficiency, has very little incentive to push you toward it. Your advisor charges 1% of your assets. If you move money from a traditional IRA to a Roth, you still have the same amount of assets. Their fee does not change. Their incentive to run the Roth conversion math for you is essentially zero. Lazy investing built more fortune than crypto memes. But even lazy investing requires knowing when to not be lazy. And in 2026, the specific intersection of the super catch-up expiration for 63-year-olds, the income valley conversion window, the OBBA senior deduction running through 2028, and the Social Security Trust Fund math all pointing in the same direction. That intersection is not an accident. It is the tax code telling you something. The tide is still out. The ocean floor is right there. Whether you walk down to it or watch from the shore is up to you. Sources referenced: Social Security Trustees, 2025. Annual Report, SSA.gov. Congressional Budget Office, February 2026. Long-Term Outlook, IRS Notice, 2025 to 6-72026 Retirement Plan Contribution Limits, One Big Beautiful Bill Act PL, 119 to 2, one signed the 4th of July 2025, Secure 2 Act of 2022, Empower 2025, average 401k balance data, Income Laboratory Roth Conversion Strategy, 2026. Guide, Kiplinger, 2026. Retirement Benchmark.